What's up, everybody? We got to talk about Microsoft destroying Google. You saw the news. Chat GPT is destroying Google, and Microsoft is entering into search, and so that's the end of Google. Google's done. It's over. That's the narrative headline. I obviously don't believe that's true. I own Google in my portfolio. So today we're talking about the threat of Microsoft to Google, which there is a threat, why I don't think it's actually the end of Google, and why I don't think this is a bad time to be invested in Google right now. And then I'm going to share up front right now, I'm going to share my portfolio. We got a major update because we had a crazy good week and a crazy good start to the year, but I wouldn't expect it to continue this way. So let's jump into it. Portfolio update. I always share this here on the channel. If you want more in-depth stuff and more in-depth stuff about every single trade, my newsletter is the place to get that. It's linked in the description below, austin.substack.com. We've got a $150,293 portfolio all time, and we started this portfolio February 16th, 2022. We are up $14,149, which is showing a return of 17%. We have put in right around $136,000. Year to date, this is what I was talking about. $39,955 gain, and the current value is $150,293. Let's jump into the positions, right? And we're just going by size, and this is where you're going to see a lot of changes. Again, all of this stuff is available more in depth in my newsletter, so we're just covering it right here. Tesla's my largest position, then Taiwan Semi. Brookfield is now third. Alibaba, which I said I would never own, is fourth. Wrote about that in the newsletter. Meta is now down to fifth. It was the largest position, but look how much we're up. I talked about why I sold those shares or trimmed shares in my newsletter. And look, new portfolio stock here, Google, right? I took a lot of what I trimmed from Meta and invested in Google. Then we got Rocket Lab, Snowflake, Datadog, Pinduoduo, which I also bought with some of the proceeds from selling Meta, Mercado Libre, and BAM, Brookfield Asset Management. So recently I have sold Shopify and I have sold GitLab. Reason being is I am just investing into, if I'm in the cloud right now, the exposure I want is Snowflake and Datadog. I just think they're cream of the crop, and I'm happy to own those two for the long term. They're probably overvalued over the short term, whatever. I think the business is going to play out and they're both going to do well. And I saw no point to own GitLab when Datadog is basically trading for the same valuation, the same multiple, with what I think is a more efficient business, a better business, and a bit larger long-term market. And I think there were other stocks that were currently more undervalued, right? Alibaba and Pinduoduo, which are two Chinese-related stocks, there's a ton of risks there with them. The bottom line is, for their businesses, for their growth, for the potential of the markets, they are trading at pretty discounted prices. I want to own stocks in my portfolio for years and years and years. The time I won't is if the thesis breaks, or if I have realized 3 years of expected gains and I think a stock is overvalued, which is why I sold Shopify. It was up so much in such a short period of time. Or if there's, a lot better opportunities, or if I need to take some risk off the table, right? Meta was up to 30% of the portfolio after all of the crazy gains. You can see it's showing up 73%. And so for me, it made sense to trim Meta and go into Google, because they're very similar companies, in my opinion, in terms of the quality of the company. And I liked diversifying that exposure a little bit, especially since now they are essentially trading at the same multiples. Again, I went into more detail in the newsletter if you want to focus on that. But this video is about the threat to Google and why I recently bought shares of Google, and my plan to likely continue buying shares of Google if they stay cheap and suppressed. It's very much reminding me of the Meta story of 2022, where everyone hated it. There was all the negativity out there. When that happens and it's unwarranted, investors can have really great buying opportunities, and I'm going to talk about why. Not every time. Sometimes it could be a huge mistake. Maybe I'm making a mistake with Google. We'll see. Anyways, the threat is that Microsoft is winning the AI-linked PR battle, right? Google shares slumped nearly 8% after the tech giant showed off several artificial intelligence linked updates to its products and services on Wednesday, but analysts said Microsoft is winning the early PR battle between the two. There's a video out there of Google let's see it gave incorrect information when it said, this is Google's AI, when it said the James Webb Telescope took the first pictures of planets outside the solar system, known as exoplanets. The first exoplanet was actually discovered in 1992, so that's why it was incorrect. Now, this was probably a mistake, but it could have been intentional, right? Because look, people are talking about it. Now it's a major news headline. If everything would have just went well at that demonstration, then there's really nothing groundbreaking. There's nothing for people to talk about as a major news headline that's going to drive attention to Google in this whole race, because Microsoft was kind of the first mover there, and all the rage is about ChatGPT right now. This reminds me of a little play out of Tesla's playbook where Elon brought the Cybertruck on stage and threw a rock at the window and cracked the window when it was supposed to be bulletproof. Jury's still out whether that was intentional or not, but hey, everybody's talking about it and everybody remembers that event. Everybody is going to remember this event because Google failed, right? So just something to think about there. They're totally capable in the AI world. And the bottom line is, I just think this, right? This disruption in general, sure, it's possible. Disruption doesn't happen immediately from one day to the next, where something new comes out and it just destroys such an established market, which is what Google has in search and dominance. It takes time. So we may see Microsoft start to take market share. We may see them start to disrupt Google, but it's not happening overnight, right? The people who use Google services and Google Map and Google Search and run their businesses, optimizing for Google SEO and marketing, they're not gonna just immediately switch all of this stuff over to Microsoft and Bing and Chat GPT. Very likely they're gonna use both, right, and experiment for a little while. But if you think about, why would Microsoft be entering this market? Because the opportunity is massive. And so there's room, much like in cloud, for Amazon and Google and Microsoft. There's going to be room in search for all of them, right? The future may look like Google doesn't dominate the search industry as much, but they're investing in new markets. And oh, by the way, they have a pretty powerful AI tool that they're going to be able to incorporate directly into Chrome and Google Maps and Google Search and SEO, and provide businesses insights that already use Google Performance Max and Google SEO, their different search products that they pay for marketing in. They're going to be able to incorporate Google's AI, and they already are, right? It's just hasn't put a name directly on it. Google's going to be able to incorporate that directly into their services and platforms. And I think this is a lot of fear about, really something that's not going to impact immediately and may slowly start to impact over time, right? So let's talk about numbers a little bit. This is Google's most recent report, and let's take a look at their quarterly revenues in 2022. This is at the end of 2022. $76 billion in quarterly revenue. It was up 1%, 7% in constant currency. Operating income was 18%, operating margin 24%. Just fantastic numbers, right? Let's get to where that revenue breaks down. Where is it coming from? Google Search and other is $42 billion. YouTube ads is $7.9 billion. Microsoft entering into, using Chat GPT and Bing, in my opinion, in no way threatens the YouTube platform, at least not right now. We'll see if that comes to be true. I think the YouTube platform is just going to be a cornerstone of content and media and Google's business, Alphabet's business, for many, many years to come. So I think there's room for growth there. Google Network, $8.4 billion. And so all in all, that comes out to $59 billion in advertising. And then Google Cloud, here we go, $7.3 billion in revenue. That's growing nicely. It's going to continue to grow. They've got other bets, which isn't meaningful at all. And then hedging gains of $669 million. So all in all, $76 billion. The fear here is that most of their revenue comes from Google advertising. 59 billion of the $76 billion in total revenue comes from advertising. If Microsoft begins to take share of that, that could be a major threat to Google's business. That's what this reaction is, right? Let's take a look at Microsoft, right? Is advertising something that they're good at and set up as a company to do and to take market share? That's what we need to be thinking about right now. Revenue and productivity in business processes. This is for the quarter, 17 billion. Revenue in intelligent cloud, 21.5 billion. Revenue in more personal computing was $14.2 billion. So in here, this tells me Microsoft doesn't have a ton of domain experience and technical experience in the advertising category. And Bing, for all intent and purposes, has just been not a failure, but just not meaningful, right? And so it's a big leap to think that Microsoft is automatically going to be set up to take over what Google has been so good at for so long, right? And so I think it's just as likely that Google is able to enter into a new market and be successful as it is that Microsoft is going to enter into Google's market and take them out, right? And again, if that does happen over time, Google's got time to move into new things, right? So let's look at these companies head to head, and let's talk about why I own Google and I don't own Microsoft, and I don't plan to right now, even though I think it's a great company. This is Stock Unlock. I'm a paying member. I love this website. Here's Google on the left side. Here's Microsoft on the right side. Next year, projected EPS for Google is expected to be 23%, which is better, more growth than Microsoft's EPS growth, which is 11.99%. Projected revenue growth, 10.18% versus 9.3%. So we could see that's flipping, right? This is just projected, so who knows what's going to actually happen. Next year, projected EBITDA, earning before interest, taxes, depreciation, and amortization, 32.89, 12.80. Average analyst rating 4.2 versus 4.17. And then the price target. So analysts currently have the average price target is 33% higher right now for Google than the share price currently versus 13.7% for Microsoft. So bottom line is, I think that Google is just a better value. It's more undervalued right now than Microsoft. Microsoft does pay a little dividend, which is nice, so it's something to keep an eye on. But hey, I think Google could do that in the future too. They have been increasing the dividend. It grew 10% over last year, 10% over the last 5 years, a low payout ratio. So they've got plenty of room to keep paying and growing that dividend over time. Okay, financial health. I mean, they're both extremely healthy companies. The thing that I would just pay attention here is shares decreasing, right? Google has had more of a focus on decreasing share count, minus 3.58%, versus Microsoft, minus 1.09%. Again, remember, Microsoft pays that dividend, so they could easily flip that and decrease shares. So whatever, it's basically the same, but they're both decreasing shares versus diluting shares or adding shares, which is good for investors over the long term if they do it appropriately, right? If a company buys back shares at extremely high prices, that's actually a bad investment, which a lot of companies do that. Okay, growth. So this is over the last year, right? Revenue increased 9.78% for Google, 10.38% for Microsoft. Gross profit increased 6.77%. Versus 9.3%. Operating income actually decreased. This doesn't mean it's negative operating income. It just means it decreased from prior years, which they just had very profitable years coming out of the pandemic. And so that's kind of understandable. The business is just kind of reverting to the mean, right? Profitability. Okay, gross margin, 55% for Google, 68% for Microsoft. Operating margin, 26.46% versus 40%. 21% net margin, 33% net margin, 21% free cash flow margin, 29%, and cash conversion is 100% versus 88%. Okay, something to think about here. Google has their established businesses, and Microsoft has a pretty high gross margin, a high operating margin, a high net margin, a high free cash flow margin. Does management have the permission and the ability from shareholders to risk these margins and risk the operating margin, risk the net margin, risk that free cash flow margin to invest in what is going to take a lot of investment to enter into this search market and actually take meaningful market from Google? that's going to take a hit to their profitability over the next few years. And we saw what happened to Meta when they made a major shift to the business. Now, that was a lot more unknown than going into search, which is already an established market. But management teams, when they've got huge investor bases and huge investors, they are pressured to make decisions that investors are happy with. And so the question is, will Satya Nadella be able to stick this out if it does hit their margins and they start to see a quarter or two or three where they're not making as much progress as people think? That remains to be known, right? And that's why a lot of these times when companies enter new markets, it ends up not being as scary as everyone lays it out to be. Okay, returns, they're just both great, so don't need to talk about that. Valuation, this is the other point I was making. Right now, Google has a PE of 20.3, which is below its 5-year average of 30. Microsoft has a PE of 29, which is below its 5-year average of 33. What stock would I rather own at right now at the current valuation with all the metrics we just talked about? The answer is Google. It is trading almost 30% cheaper, 25% cheaper, 30% cheaper on a PE basis than Microsoft. And although Microsoft is a little bit more profitable, I don't think that makes it worth a PE of 29 when Google's only worth a PE of 20. And so I think that, this is presenting us an opportunity to own Google. And I plan, to keep adding to my position just slowly over time. I'm not backing the truck up and being irresponsible. But if I'm DCAing into this portfolio and I'm thinking about, just investing in the market over time, Google's a pretty good representation of the overall stock market, higher quality than the overall stock market, trading at a PE of 20 or below if it goes lower. That to me is a great bet and one I'm going to continue to make, right? Price free cash flow, 20 versus 33. Price of sales, 4.3 versus 9.7, almost double, more than double the price sales ratio. Is that deserved? I don't know. And then forward price to earnings growth. So this is, what is their earnings growth? And then what is their PE currently? If it's under 1, that is generally a good thing. That means things are generally discounted because earnings are growing faster than what they need to for that PE to stay the same or go up, right? And so 0.88 versus 2.45 for Microsoft. 5-year stock growth, you could see 80% is above the S&P 500 of 53%. And so I guess it's saying it's 26.77% above. But 5-year stock growth, 195 for Microsoft is above the S&P of 53.4. So Microsoft is performing better on a 5-year basis. So I just laid it out, right? Like that is why I own Google right now and I'm not owning Microsoft. Let's look at this in a visual format, right? So this is fast graphs. You can see right here is where I bought shares. This line right here is the current share price. This blue line is the average PE ratio over this entire chart, which goes back to 2003. You can see the average PE has been 30 with a 34% earnings growth rate. We are well below that, but I don't expect it to go back to average, right? If we want to go to forecasting calculators and we want to go to estimates, we're at a PE of a blended PE right now, it's 20.5. And so if we want to go 3 years out, 3 years into the future with analyst expectations, earnings growth of 14%, 19%, and 17%, again, these are going to be different than those numbers. We can go down to a PE of 17, you get a 9.6% annual return. A PE of 18.6, you get a 13.29% annual return. And if it stays around a PE of 20, you get a 16.76% annual return for a 56% total return. That's Google. Let's look at Microsoft, right? Holy cow, look at this. Okay, the current PE of 28 is way above its historical average, right? And so let's do the same thing. Let's look at what analysts are expecting for the future. We're going to forecasting calculator. We can see analysts are expecting earnings growth of 1.5%, 15, and 16. And so if we go down to the same numbers, 16.5% PE is a minus 8% annualized return for minus 18% total return through 2025. If we jump up to that 18, you're looking at minus 11% total return. And again, if it trades to around a PE of 21, which is above the PE of 20 that we did for Google, then you're looking at a 3% total return for the next 3 years for 1.3% annualized. I just laid out why I own Google and I don't own Microsoft. If you like these videos, if you like this type of analysis, I'm not talking about get rich quick stuff. I'm talking about long-term investing and building $1 million portfolio over time. You can support me by subscribing to the channel and liking the video. Leave a comment down below with your thoughts or stocks you want me to look at, maybe something I overlooked. And then if you want to, check out the email newsletter, austin.substack.com. And have a great day. Come back for the next one.